Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. We're looking at gains across the board on the final trading day, the first half of the year. We're looking at the Dow up just over 300 points, S&P up just over 1%. We're ending the first half of the year similar trends to what we've really seen play out over the past 6 months, and that once again is technology leading. Tech is leading the gains once again today, pushing the Nasdaq up just about 1.5%. And today marking a major milestone for Apple, about an hour away from closing at a $3 trillion valuation for the first time. Today's move higher driven by an upbeat note from Citi. The analyst there initiating coverage on the stock with a buy rating. $240 price target. That's the highest here on the street. And Akiko, when we talk about Apple's momentum, a lot of people asking just about the valuation of Apple, how much room it has to run. Citi certainly thinks we've got a ways to go.
Yeah, and it's surprising when you consider the stock is up, roughly 48% on the year. Obviously, Apple not the only name in the tech space. We have seen this broader rally we've been talking about for some time. But here's an interesting take, Shauna, because the Wall Street Journal highlights the potential risk that comes with an Apple $3 trillion valuation, saying the last time Apple's market value came within about a 1% of that $3 trillion level was the first week of 2022, and we know what followed after that. Major tech sell-off that took more than 30% off the Nasdaq. So, you know, it's worth taking this with a grain of salt. Yes, the $3 trillion cap is significant. Apple's seen a significant run-up on the back of their mixed reality headset. That's given the stock a boost as well, but time to take maybe a bit of a breather given the run up on the stock.
Yeah, exactly. And I think that's what a lot of people are asking just in terms of the valuation, where it's trading today. Right now, it's trading about 30 times forward earnings, which is well above the 10-year average, what we typically see from Apple. So really that lends to the point there that you were just making from the journal, just lots of questions about valuation and exactly what we saw the last time that Apple did push above $3 trillion on an intraday basis. And I think it's also, we've seen this a little bit in terms of the sentiment shift a bit on Wall Street. Yes, a Citi coming out with a buy rating today, but UBS recently downgrading the stock, questioning the current valuation, the massive run up that we've seen in tech. Maybe now is a time that we could see a breather. We could see a bit of a pullback here in the second half of the year. But for right now, and at least for our sake, I'm hoping it closes above $3 trillion.
Yeah, I mean, it would certainly be a significant number for the company. I do wonder, though, how much of this holds, especially given the excitement that's been around Apple and that mixed reality headset, you know, still to be determined just how significant that demand is going to be in the market. A lot of question marks, but you're right. At least for today, going into the holiday weekend, we are still talking about Apple here hitting that $3 trillion mark, certainly a significant milestone for the company. Well, new economic data today points to a continued pullback in inflation. The Federal Reserve's preferred inflation gauge falling to its lowest point in 2 years last month. Fed Chair Jay Powell, though, making clear this week the central bank is still far from reaching its inflation target. Joining us now is Troy Gajewski, FS Investments Chief Market Strategist. Troy, let's start with some of those comments that we got today, or we got earlier this week, because that comes in light of this economic data that points to further cooling down of prices, at least in core PCE. How should we look at that number when you consider the Fed is insistent on additional rate hikes going into the year end?
Yeah, so look, we've made tremendous progress in a relatively short period of time with regards to inflation, but obviously inflation is still extremely elevated relative to the last 20 to 30 years. And, you know, it does somewhat surprise us that the Fed is committed to hiking at least one, maybe two more times at a time where they're draining their balance sheet aggressively, and the Treasury is sucking out hundreds of billions of dollars every several weeks to replenish their checkbook after the debt ceiling limit was launched. So, you know, from our perspective, you know, there's probably only 3 to 5% more upside left in this rally as it runs out of air or support. And there's potentially as much as 20 to even 25% downside from here as the forces of liquidity reassert themselves that did so powerfully last year. The Fed continues to hike. And then just as important, and this dovetails to, like, why is the Fed hiking more when the consumer is starting to run out of gas and you're starting to see the cracks in the labor market, is that, you know, the U.S. consumer has been single-handedly keeping the global economy afloat. And fortunately, that's not quite the case anymore. But as soon as the labor market starts to crack, the initial Fed reaction is going to be to high five one another that inflation truly will go back to 2%. But inevitably after that, we'll have a mild recession, which last we checked is not terribly good for earnings or revenue.
Yeah, Trey, I just want to double check what you said. You said that we could have a 20 to 25% pullback from here?
Oh, certainly. We've always thought that this bear market was not over. We've been surprised, though, to be fair, at the power of this bear market rally. The strongest rallies in markets are always in bear markets. You go back to periods like 2001 or 2008. Ultimately, you run out of liquidity support. And right now, you think of the two clear and present dangers. The first is liquidity is being drained at an aggressive pace, which means it's harder for assets to go up and easier to go down. And then the second, which is really the first time we've dealt with this since the pandemic, is the probability of a recession starting, from our perspective, as soon as Q4 this year, is arguably 70 to 80%. 2022, the economy was not a problem. Coming into this year, the economy was not a problem. It will soon be one of the biggest threats to equity prices and valuations over the next 3 to 6 months.
Troy, what happens if the Fed does not raise rates then? Even at these levels, you're saying that we could still see that big of a pullback?
Yeah, no. So stepping back,
level,
right,
yeah.
from a risk-taking standpoint, one of the most important metrics to focus on is money supply vis-a-vis nominal GDP. When money supply is growing meaningfully faster, markets tend to appreciate. And after the 42% surge we had in the pandemic, which helped drive that wonderful green light go environment in 2021, the Fed's been draining liquidity aggressively through their balance sheet, and also by flattening and then inverting the yield curve, which has completely crushed credit creation. So even without one or two more hikes, the likelihood for further downside is acute. But one or two more hikes will only reinforce the probability that we're going to have a recession starting as soon as Q4. And by the way, we didn't even talk about bank lending. That's completely stagnated. It's very difficult to grow an economy that's dependent upon credit creation when banks just aren't lending.
So where does that leave you right now? I mean, if we're talking about a recession, a significant pullback going into Q4, where does that put you as an investor?
Yeah, so look, there are so many silver linings of the current environment, right? One is risk-free is a lot higher than any of us ever dreamed of, and you can make a decent return in cash. The second is that there's a variety of alternative strategies that can provide growth, like private equity, middle market secondaries. That opportunity set is booming because there were so many institutions that over allocated to private equity and are now in the process of winding that down, and they have to sell into the secondary market at a significant discount. So that's a wonderful opportunity where you can make above equity like returns with less volatility and risk, and will have less downside as liquid assets pull back. The second is, if you think about what's going on in the banking industry, right? Banks have started to retrench. They're not going to grow lending at an aggressive pace anytime soon. So it's really the best time we've seen to be a private lender since the global financial crisis. But the key to that, and this is crucial, you have to have dry powder to take advantage of a liquidity vacuum. So whether that's senior secured commercial real estate loans, or that's middle market private equity, or private credit, that looks to be as good as it's been in over a decade. And then lastly, in more liquid strategies, if you don't want to chase NVIDIA at 30 times forward sales, or Apple as it goes from $3 billion to $55 trillion market cap, we've seen a significant slowdown in refinance activity in markets, and this has been driven by much higher interest rates. And so there are cash flows that benefit from slow refi activity. And so that's one of our favorite strategies now in more liquid markets, where you don't have that illiquidity premium like you have in private equity or you have in private credit.
Troy, how should investors be thinking about the allocation of that within alternative investments when they're trying to split up their portfolio? How much of that should be dedicated to some of those ideas that you just ran through?
Yeah, so it's so dependent upon the end investor and what their risk reward objectives are, and their liquidity position, their age in life, whether they're a large institution or a smaller investor. But ultimately, when you think about the big picture here, we had excessive asset returns from 09 to 21, driven a large part by multiple expansion and limitless money supply growth. That's not coming back anytime soon. So you should make alternatives a meaningful enough part of your portfolio to help you achieve your wealth goals. So think about high single digit returns with lower risk. So you have to do enough to move the needle. So you might want to start at 5%, gradually grow that to 10. Obviously, if you're more heavily allocated now, you want to broaden that out from 20 to 30. No one's arguing that the average investor should have over 60%, like many of the large endowments do and have for years and had a lot of success doing so. But ultimately, when you're focused on strategies like this, you end up with less volatility, less knee-jerk reaction, less selling of bottoms and buying of tops, and a smoother, consistent return stream, which helps everyone, whether you're an endowment, a sovereign wealth fund, or an average investor, hit their their savings and retirement goals.
So where does that leave you in terms of the equity space? I mean, particularly large cap names. Are you starting to kind of pull back from that?
Well, I'll tell you what we've done in our more liquid multi-strategy solutions is we're trying to take advantage of the last gasp of this bear market by resetting a lot of defensive positions that can provide positive returns if markets do in fact go down as we expect. But, and this is the key but, and this really wasn't available until about 3 weeks ago, because volatility has come down as much as it has, you can put on defensive positions like put spreads or barrier options that don't clobber you if markets keep melting up, but provide attractive upside if markets roll over. So given how narrow this rally's been, given how dominant it has been by mega cap tech, 5-7 names, when markets roll over, it's inevitable that they get hit as well. So we just think the risk reward of chasing this at this stage of the game is not in one's favor if you're focused on consistent positive returns as opposed to, frightening periods of excessive outperformance followed by frightening periods of excessive declines.
Yeah, frightening the word. There it feels like on both ends. Troy Gajewski, FS Investments Chief Market Strategist. Good to talk to you on this Friday. Have a good weekend.
Yeah, have a great holiday weekend.
The Securities and Exchange Commission reportedly rejecting recent filings for a spot Bitcoin ETF. Bitcoin sliding on the news. Here with more on this, Yahoo Finance's Jennifer Schomburger. Jen.
Hey there, Shauna. Yeah, that's right. The Securities and Exchange Commission reportedly found that a handful of spot Bitcoin ETF applications just aren't adequate. The Wall Street Journal and Reuters are reporting that the SEC told the Nasdaq and CBOE, which have filed applications on behalf of asset managers, including BlackRock and Fidelity Investments, that their applications aren't sufficiently clear nor comprehensive. The SEC, Fidelity, and BlackRock declined comment. Following BlackRock's lead, Fidelity Investments, Invesco, and WisdomTree were among some of the names who reactivated or amended their applications for a spot Bitcoin ETF. Several managers have filed applications with the SEC for a spot Bitcoin ETF over the past couple of years, only to find them rejected. The SEC has argued that spot ETFs are vulnerable to fraud and market manipulation. Spot ETFs hold the actual underlying cryptocurrency like Bitcoin. The Commodities Futures Trading Commission has approved Bitcoin future ETFs, which consist of future contracts that track the cryptocurrency's price and may or may not move in lockstep with the underlying asset. Bitcoin and other crypto stocks have rallied since mid-June when BlackRock filed paperwork with the SEC. Of course, not looking like the SEC may be changing its mind anytime soon about these Bitcoin spot applications. Back to you.
Jennifer Schomburger, thanks so much for that. Well, we are just getting started here on Yahoo Finance Live. Coming up, the Supreme Court striking down President Biden's student loan forgiveness program. What does that mean for those who have to restart those payments? We're going to break that down on the other side. Plus, we're going to speak to an economist who says commercial real estate value won't reach pre-pandemic levels for more than 15 years. We'll have more on that later in the hour. And we are counting down to the final closing bell of the first half. We're going to recap the biggest winners and get you set for what to watch in July. All that and much more when Yahoo Finance returns.
U.S. is considering new restrictions on AI chip shipments to China, according to a report from the Wall Street Journal. This as concerns mount over the possible threat of an advanced AI in the hands of U.S. rivals. Shipments to China from chip makers like NVIDIA could be blocked by the Commerce Department as early as next month. Chip maker shares falling pre-market on the report.
I think this is where the rubber meets the road, and I think AI is a great story. I think it's hard to argue against the fact that it could change the world. But these bumps happen when we're talking about new technologies, and this is a very new trend. So I would tell investors that, this is kind of part of the process. This is the world figuring out where AI fits, and there are going to be ups and downs.
This group has had an unbelievable run, and whether it be the AI stocks in general or the chip stocks in particular as well. So it'll be interesting, not only this week, but as we move into next week, a lot of these institutions, they might start to pull back a little bit because of this concern.
Because there's concern about whether the Biden administration is going to put any restrictions on the ability of these companies to export their goods, then those valuation levels could come in. There's plenty of profits to take off the table. Might an air pocket be coming if that's the direction the Biden administration wants to go? Certainly that's something you can't rule out.
I spoke to one strategist over at Baird, Ted Mortensen, who basically said that this is turning out to look like into almost a geopolitical economic warfare issue. When you are restricting the exportation of these chips, you are basically trying to restrict economic growth in one country, and you're also trying to restrict their military advancements. This is going to be sort of a red line when it comes to China in trying to restrict this.
The Supreme Court striking down President Biden's student loan forgiveness program today. The ruling blocks the president's plan to cancel $430 billion in debt. And that was a campaign promise affecting more than 40 million Americans. Those who carry student loan debt will now have to start repaying those loans in October. So what should you be doing now? Joining us now is Midland Financial founder and author of Financial Planning Made Personal, Lawrence Sprung. Lawrence, I'd imagine you've probably gotten a lot of calls from those students who have to repay those loans to say, well, what does this now mean for my finances if we're talking about monthly payments of upwards of $300-400?
Sure. Great point. And thank you for having me. We thankfully have not been getting those calls personally because we've worked with these young individuals to make sure that if they were in this situation, that they had a plan. And we've been working with them under the expectation of a worst case scenario that this debt was not going to go away and they would have to resume payments come October of this year. So, that is a hugely impactful and beneficial way of attacking things. Now, if you haven't done that, that's something you certainly should start thinking about today.
And Lawrence, just more specifically on that, digging down into exactly what that plan looks like, what's the first couple of steps that people should be taking right now?
Yeah, so even the folks that we started with a plan when this was first announced, we obviously have been revisiting it in recent weeks in expectation of this announcement coming out. And now what we're in the process of doing is relooking at their situation, putting a plan together, looking at their budget. It's going to be very important to make sure that we take a look at how much money they have coming in, because that could have changed in the environment in the last 3 years, where their money is going out each month and those expenses to make sure that they're going to have sufficient cash flow to pay for these payments as they restart. Now, if they're in a situation where that number is not in a situation where they're going to be able to repay, it's important that we look at those expenses with a fine-tooth comb and see what may be able to be extinguished. What subscriptions do you have that you're paying for that you may be able to get rid of? What other expenses will you maybe have the opportunity to reduce to make room for these upcoming payments?
Yeah, so it is about shaving down your expenses, sort of just looking at what that personal balance sheet looks like. But when you think about it, a lot of students, today we're talking about the president's student loan forgiveness program, but there's also been the COVID-related payment pause. There's a lot of students out there who graduated from college who haven't had to pay anything for 3 years. If you are in that position where suddenly you're faced with that, but can't necessarily meet those payments, what are the other options?
I think you have to start looking at all of your options, which may be looking at other ways to refinance that debt, other opportunities where you can move it maybe to a private lender. All bets are on the table at that point. I mean, it's something that's certainly new, but again, this is why you have to have, and we talk about it here at our firm all the time. It's so important to have a plan because you don't want these things to creep up on you. It's important that you look at all of your options and make a decision that's what's in your best interest, whether it be a private loan or looking to extinguish the debt in some other way. But the bottom line is, either way, these payments are coming and you have to be prepared to start paying them or pay off the debt.
Lawrence, what do you think the roadmap from here on out looks like? Because we know President Biden, he's going to face even more pressure to get something passed, get something that will be able to be upheld. Is any future negotiations, is that off the table?
Listen, I'm not a lawyer, but my understanding is that there are other options that exist, but it wouldn't be through the HERO Act, which is where he tried to enact this initially. It would have to be through some other kind of legislation or congressional action. I think of the likelihood of that taking place this late in his term. I find it highly unlikely that there's going to be a plan B and this is going to be addressed again. What I would like to see, however, is a greater plan to attack the student loan debt situation as a whole, because although this was going to extinguish about $500 billion or $500 billion in debt, we have a $2 trillion problem, which even after this, whether it was extinguished or not, is going to continue.
Lawrence, I want to get back to something you said there about the potential for other options, including private loans. And obviously, your clients have been looking ahead. They've been preparing for the worst, but not everybody has been there. Is that an option that you would advise on?
Well, I think you have to be a little careful with that, because if there is some kind of option B for some kind of abatement on these on the debt, then once you move it to a private loan, you're going to be out of the mix for that debt. So you have to make a personal decision as to whether or not you are willing to risk that. And you also have to weigh the benefits and the disadvantages. Maybe there are better rates, maybe there aren't. And, we're not in a situation where we were 3 years ago, where interest rates were extremely low. They've creeped up quite a bit. So that's got to be part of the conversation as well.
Lawrence, from the conversations that you're having, you mentioned the fact that this doesn't, obviously, the $20,000 of forgiveness that President Biden was pursuing, that it doesn't address what's at the crux of this issue here. The conversations that you've had with these students, are they rethinking higher education? Are they maybe stepping back and pausing just in terms of what makes the most financial sense here for them to do at this point?
Yeah, I agree. Yeah, I do think that's the case. I think we're seeing more folks that are exploring the options of trade and technical schools, which are great options. I think we've created this construct in this country that, you have to go to college, that you go to high school, and then that's the natural order. And, the trades have suffered as a result of that. And there's great opportunity for people who are willing to go down that route. And they could come out of high school learning a skill, earn a very good living, and not have the opportunity to amass this debt. So I think that a lot of folks, when they're exploring higher education, should certainly take that into account and really make their decision on whether college or whatever route they want to take is right for them, based upon due diligence, not based upon, where they want to go, the sunshine environment, good football team. There has to be a return on investment there, and it has to be looked at. Many folks spend more time evaluating, what car they're going to buy and whether that makes sense and what, features and benefits they're going to get than they do when it comes to higher education.
What does that return on investment look like when you compare it to a four-year university to potentially some of those trade schools you just mentioned? What's the discrepancy? Because the argument has been that, at least regardless of what your decision is, when you are valued in the labor market, that four-year degree still holds value in that you can command a higher salary.
Yeah, I think that that's a valid point, but I also think that this has been a construct that's been created by the environment we're in. And I think one of the culprits of the student loan crisis are the schools themselves. They are great marketing machines who are telling our students and our young folks that what you just mentioned is exactly the case. I do not feel that's the case, because if you look at it side by side, the person who goes to trade school or whatever route they take is starting with a clean slate. They're not going to have any debt, and their earning potential starts immediately. And I think at the end of the day, they could end up in a similar position whether they go to college and get the 4-year degree or not. And, it's really a personal decision. Some careers may need that 4-year degree and may need higher education. Others may not. So it's really, like I wrote in my book, financial planning is personal. It's very personal. And I think it's a decision that has to be made with a lot of factors in mind and not just, where should I go to school? What's the environment I want to be in? It really has to look at what is the return on my investment. And I did this personally myself. I have one son right now in college. He's a sophomore, and one son looking at school in the next couple of years.
Certainly very, very important points to take into account. Lawrence Sprung, great to talk to you. Thanks.
Thank you so much.
Coming up, it's been a tough year for commercial real estate as offices remain empty. How long until we see a recovery? More on that when we return.
Signs of distress in the commercial real estate sector as very few lenders are now willing to provide financing. Our next guest expects this trend to continue and says that office values won't regain pre-pandemic levels until 2040. For more, let's bring in Kiran Raichura, Capital Economics Deputy Chief Property Economist. That's a very, very long road when you consider some of these developers and when those current mortgages, that debt's going to be due. What does that suggest in terms of the risk of default, which has really been hanging over the market?
Yeah, thanks for having me. It does suggest that we're going to see a large number of office properties handed back to lenders, and we're already starting to see some of that happening, both in terms of some specific loans where property owners have worked out that it doesn't make economic sense for them to hold on to those assets, and then they've handed those back to the banks, particularly in some of the hardest hit cities. And we're also seeing increasing distress amongst CMBS loans. So the office CMBS distress delinquency rate is now above 4%.
Kieran, when you take into account what happened in New York this week, the big deal, SL Green selling the 50% stake in one of its Grand Central buildings for $2 billion, does that add any sort of comfort just in terms of the fact that, hey, maybe it's not as weak of a position that we initially thought it was?
I think, there are always going to be some buyers out there, for assets to transact. There have to be buyers there. And we know that's what happens in a downturn. Activity slows, but there's still people who look to take those opportunities. But what I would say is that a lot of the assets that are transacting are doing so at substantial discounts to the values they would have transacted at previously. And so there are really good examples of buildings, particularly in the worst hit cities like San Francisco, that are transacting at between 50 and 70 or 80% less than what they were previously valued at some point prior to the pandemic.
So what brings that value back? I mean, I realize we're talking about 2040. That's a long way away, but you're saying we can get back to that level, right?
Yeah, it's actually very easy to see this take much longer than that. So actually, I've been recently looking at what happened following the GFC, and we had a peak in office values there at the end of 2007, and they literally only just regained those peaks by the end of 2019. So even then, that was a 12-year period. What we're expecting to see here is a much slower recovery because of the structural hit we're expecting to see because of the reduced use of office space. And so actually it's very easy to see values take much longer to get back to those levels. And actually the kind of growth rate we've assumed to get back to the peak after the size of the fall we're expecting over the next few years is higher than the rate we've seen in the last 10 or 20 years. So actually, it's quite possible to see that recovery take much longer than the 15 years that we've kind of penciled in, and it could be well into the mid-2040s even.
Well, Ken, that's a lot to digest because I think a lot of people are just scratching their heads whether or not we were ever going to get back to those value levels, but then saying that it could be well over 2 decades away, I think is obviously concerning in terms of the economic implications, what that could mean for the broader economy. But before we get there, just in terms of the office conversions, because we started to see that pick up just a bit, is that going to help cushion any of that blow?
It will help those assets where it's possible. One of the issues with converting office to multifamily, which is the kind of the most obvious use case that often gets held up, is that the kind of configuration of buildings isn't great for multifamily because you need to have access to light usually in a flat, in an apartment. So unless it's a very small floor plate, it doesn't really tend to work that well for conversion to multifamily. And the other thing as well is in a lot of cities, it's not really very easy to do so in terms of planning permissions. So I think we need to see more action from cities and city planners to actually enable that and, if anything, support that conversion to try and make sure there is still a constant flow of people and businesses in their CBDs.
Kieran, you mentioned a 4% delinquency rate right now. How much higher do you expect that to go up in the years ahead?
So, we don't specialize in the CMBS market, but it'd be quite possible to see that reach double digits by the end of this year. Certainly, the data comes from a company called TREP, and they on their podcast have been talking about double-digit rate by the end of the year, and I think that's quite reasonable. We saw a much bigger spike than we've seen so far following the GFC, but it's much more of a slow burn this time because the way that offices are being, how the hit is playing out is much slower because it takes firms to vacate their space when they have either a lease expiry or by subletting that space. Whereas in the GFC, we had this period where firms just went bust and vacated that space immediately and the landlords stopped receiving rent. This time around, landlords are still receiving rent, but that rent roll is going to gradually reduce for the average building over the next few years.
Kieran, what about the rest of commercial real estate? You briefly mentioned multifamily there just a minute ago. What about industrial? What about retail? How is that faring in this environment?
So there's a general hit to values, which is coming from this increase in interest rates that we've seen over the last year or so. So if you think about the end of 2021, the 10-year Treasury was at 1.5%. It was about 3% by the end of last year. We're now kind of in the mid to late threes. And that has a bearing on how property is valued. And at the same time, we've also seen an increase in debt costs. So for those buyers who are using debt, that also has an impact in terms of how much they can pay for a specific property. So we're still expecting to see a hit to values in all sectors. So for apartments and industrial, we're around 22% peak to trough. But what I would say about those two sectors is that they have strong fundamentals in place. So for industrial, there's this long-term trend which is being supported by e-commerce growth. So we think there's a good medium and long-term story for that sector. There's just essentially a pricing correction happening right now to this new level of interest rates. And for multifamily, it's quite similar. In general, the US is fairly short of housing stock, and it's a sector that tends to do well also if we have inflation, which we already have had in recent times, because there tends to be a better link to earnings growth. So again, there we think the medium and longer term prospects are pretty good. Just in the short term, there's this supply overhang coming through because of a lot of new supply completing in the next couple of years. And then retail, the one which had been struggling the most previously, is the one where we think the prospects are actually best over kind of the next 1, 3, 5 year period, whatever you choose. So we've got around a 10% peak to trough fall in there from mid last year. And actually from next year, we think returns will probably turn positive for retail assets.
Yeah, so some positives to take away there, but a gloomy outlook for at least offices, no matter how you look at it. Kieran Raichura, Capital Economics Deputy Chief Property Economist. Good to talk to you today.
Thank you.
A record number of Americans are struggling to pay their rent, and it may not get better even if we see more apartments become available soon. Here to explain is Yahoo Finance's housing reporter, Rebecca Chen. And Rebecca, why isn't this good news? Why won't renters see some relief if we do see more apartments come online?
One of the biggest issues with today's rental market is that more and more buildings that are coming on proportionally are luxury apartments. In fact, in the last 20 years, it used to be just 1/3 of new apartments are luxury homes, but now more than 50%, 51% for this year are luxury homes. And they usually ask for rents that not many people can afford. And this is really becoming a problem because at the same time, a record number of Americans are struggling with paying rent. One data that we came across is that 49% renters are now cost burdened by renting a home. And what that means is about 22% of Americans, they are paying 30% or more of their income. And of that number, almost 12 million Americans are severely burdened, which means they're paying more than 50% of their income on their rent.
So, Rebecca, does that mean we're likely to see a shift in the luxury supply chain, given that there's a strain on affordable apartments?
Based on what I've been talking to about this topic, it seems like unfortunately, it will take some time for the market to shift because as of now, it is still more profitable for developers to build luxury housing. And there's really a couple reasons for that. The majority of the cost of getting a construction building, it goes into buying the land, goes into getting a permit, and goes into building the foundation. And when you add in the fancy stuff like having a granite countertop or having a pool and a gym, those really doesn't add much to the overhead, but these nice amenities, they can go for premium rents. And this is why a lot of developers are still focused on this luxury apartment, and that's why we're seeing that taking over the market share currently.
Rebecca, there certainly is a lot of demand. People are still being priced out of buying a home, so they're being forced to rent. When you take a look at those vacancy rates, what are you seeing there?
So vacancy rate has been at a very, very low in the past couple of years. We are seeing it came back a little bit to about 6.3 in 2023. That is a lot better than the 5% that we've been seeing in the past. But to have a very healthy and balanced market, we need to see something more around the 8%. And the reason for this is so renters have more negotiation power when there are more empty apartments on the market. So as of now, we still definitely have ways to go in terms of affordable housing.
All right, Rebecca Chen, thanks so much. Well, coming up, we are counting down to the final bell of the first half of the year. We're going to dive into some of the stocks that you should be watching out for, like Target, as the calendar turns to July. Stay tuned. It's officially the last trading day for the first half of the year, and following a massive rally in tech, investors are looking for their next best bet. So what should you buy and what should you avoid? Here with some of his picks, Ken Mahoney of Mahoney Asset Management. Ken, it's good to see you again. So let's just start where we're closing out the year, or closing out the first half of the year, I should say, and that's all the focus on tech. Questions about valuation, whether or not there's still a buying opportunity within the sector. What do you think?
I think there is, and still are top holdings. And what a great first half of the year. Happy Friday to you. I mean, think about it. It's the best first half for the Nasdaq in 40 years. And I think AI is the culprit. And all good news around AI and the adaptation of it. I mean, companies are going to be able to help out their top line, reduce costs in the bottom line. I think we're only second or third inning. I know a lot of people think they missed the boat, but this is one of the biggest disruptors we're going to see in our lifetime, the use of AI. So you saw the leadership, the picks and shovels of AI, Microsoft, and this quarter, AMD, NVIDIA. These are some of the names that I think are going to be around for some time and have the benefits of this huge movement we're going to have.
Why get in on this price point, though? I mean, NVIDIA alone, if you look at the run-up in the stock, it's up nearly 190% this year.
No, we're not suggesting that. Like, it's run parabolic. But the point is that there's still a lot of runway ahead of itself. What's going to happen somewhere when you say, okay, when is this really bubble? When you find $3 stocks turn to $20 stocks. This is what we saw in the late 1990s. You woke up one morning, called your company .com, and then your values like triple, quadruple, and so forth. That's going to happen. But we really do like the picks and shovels of this gold rush that's happening. I think the late 1990s was Oracle, it was Cisco. Well, now this time around, companies like Microsoft, AMD, NVIDIA. But to your point, yes, it's parabolic. You can wait and put some prices below the market, go to cancel orders, try to get filled. Maybe that's probably a better approach. I'm not necessarily saying chase it, but certainly this is not the end. We're in this great quarter, and there's no more profitability in front of ourselves.
Ken, your second pick is the total opposite. It's a bit of a contrarian play. It has to do with the energy sector, which has certainly been left in the dust this year. What's the best way to play it, and why do you think it's going to turn around?
Right. So if you have momentum going, and we know momentum could cut both ways, energy was a big winner last year. IYE is a symbol here of this ETF, which owns Mobil and owns Chevron. It pays a 3.5% dividend. And oh, by the way, I still believe there's an OPEC put somewhere around $65 a share of $65 a barrel, where it's hovering between 67 and 70 now. Again, we don't like it. We don't like that OPEC is running the way they're running, and at any moment they can go and cut a million here, a million there. But that's where we are right now. Also, our strategic reserves are way down. At some point, we're going to refill that. So I think the dynamics are, this is so out of favor. You collect a decent dividend. I believe there's a put below it here. And remember, there's a lot of geopolitical risk. I mean, over last weekend, a coup in Russia, attempted coup. There's still some areas of instability, and any instability starts really getting some momentum, you're going to find oil go higher.
Let's talk about what are some of the stocks that you're saying stay away from. We're looking abroad for this one in particular, and we've had a lot of conversations about what is the right opportunity, especially in emerging markets. Why is Brazil the one to say you need to take a step and step away?
Right. Well, I'm coming from you today from Sao Paulo, Brazil. So greetings. We're 1 hour ahead of you. So it's a socialist president, Lulu, who came into office a few months ago. Year to date, that ETF, now by the way, this is for very aggressive accounts, of 15 to 20%. And again, if you look at what happened in Venezuela, you look at other places in South America, all these policies have not worked. This is a regime that's anti-business unless you're one of the cronies. This is a socialist, and it's not going to work. Again, if you do short this stock or short this ETF or short anything around Brazil, use a buy stop, protect yourself in case it goes against you. But right now, there's such a dichotomy between the way the stock market is performing here in Brazil and also the way the politics are going, which doesn't help, I believe. And again, around the world, these type of policies don't work.
And Ken, bringing it back here to the U.S., one of the other pick that you have to avoid right now is Target, the consumer discretionary play, the retailer. Why don't you think we'll see a better second half from the company?
So we're really not really don't like retailers. We think Amazon's still eating a lot of retailers' lunch. And since the pandemic, we've all changed, right? So it used to be about buying things and going to Walmart or your favorite store. Now things are changed. People want to travel. You see airline bookings, you see hotel bookings, you see Airbnb bookings. People are shifting their spending habits away from retail. And of course, Target really tripped themselves up with Pride, which is something that a lot of corporations are celebrating. But the way they rolled it out really hurt their demographics. I don't know if they can recover from that, but certainly, you have companies that are beating estimates or raising guidance. Time and time again, you're finding retailers missing the estimates and lowering guidance. We don't be anywhere near companies like that because it's like sitting in quicksand. And I suspect this quarter that they're in, they'll probably miss the estimates. Miss the numbers and lower estimates. We don't want to be there.
All right, Ken Mahoney, great to have you here. Target off just about 11% since the start of the year. Thanks.
Right, thank you.
Well, President Biden is set to speak this afternoon after the Supreme Court's ruling striking down his student loan program. In a statement earlier today, he said the fight is not over. Yahoo Finance senior columnist Rick Newman is here with more on what this means for the president. And Rick, this is an issue the president campaigned on. He saw this as a political win, especially among the younger voters. How does he now make the pivot in messaging now that he's suffered this setback?
Biden, he did campaign on this, but he also, people forget this, but he himself expressed skepticism before he became president about whether the president has the authority to write off student debt just through an executive order. He said he thought that the best way to do it was by Congress passing legislation, and the Supreme Court basically agreed with him. So this ruling by the Supreme Court is not a surprise, and clearly the White House was prepared for it, and that's why we're going to get a new plan, the very same day that the Supreme Court knocks down the old plan. I think this is a messaging win for Biden, to tell you the truth, because he can say to voters, look, I tried, but we've got this crazy Donald Trump Supreme Court dominated by conservatives 6-3 that shot it down. So what you need to do, voters, is elect me again in 2024, make sure Democrats retake control of Congress so we can pass this legislation. And I think that is a pretty good pitch because voters actually like the Biden plan. And I want to remind people that Biden crafted this plan very carefully. He never supported complete student debt forgiveness, as Bernie Sanders did. He thought $50,000 in forgiveness was too much. That was Elizabeth Warren's plan back in 2020. And he came up with this plan. Let's make it $10,000 plus an extra $10,000 for Pell Grant borrowers who qualify. And I think the way they got to those numbers was they just looked at the polls. And they found the sweet spot in the amount of debt relief that Americans seem to support, and it's right around those numbers. So the Supreme Court, as it has done on other issues, most notably abortion rights, has ruled against public opinion here. So I think Biden is going to have a pretty good case to go to voters and say, let's do this the right way so that the Supreme Court can't undo it again.
So Biden could use this to his advantage here as we look ahead to 2024. But Rick, what about the economic implications of this? Millions of Americans are now going to have to be paying their student debt on a monthly basis. What does that mean then for the economy?
At a macroeconomic level, I don't think it's that big of a deal. It also means that this was going to cost the government. Remember, the government now writes almost all student loans. So by forgiving this amount of principal for more than 40 million borrowers, that was going to cost the government something like $400 billion, which means it was going to push up the deficit or the national debt by $400 billion. So that is $400 billion in deficit spending we are not going to have. So that, in a way, takes some borrowing out of the market. Now, you're right that borrowers who may have been expecting they were going to get this relief, they might find themselves in a hole. There are certainly some borrowers who feel overburdened as it is, just because they got too much debt and they can't pay it off. They're not making enough income to pay it off. I would like to remind people that there is another plan that Biden has been working on, which is to lower the amount of you have to pay back based on your income. So there's a lot going on here. Hope is not completely lost for student borrowers. And if you really think this is an important issue, pay attention to what the candidates are saying in 2024, because I don't think this is going away as a political issue.
Rick, finally, when you round out the week, the decisions we got from the Supreme Court certainly point to the conservative bend in really putting their mark on these decisions. To what extent do you think these decisions, yesterday's overturning of affirmative action, this particular one on student loans, is it going to have the effect of maybe, exciting the Democratic base? Is it going to, is it sort of going to be like what we saw last year with the Dobbs decision going into 2024?
I think when you look at, we do have this case study from 2022 when they overturned Roe versus Wade. Did that move the needle in terms of the 2022 midterm elections? And there's a good case that, yes, it did move the needle. Again, the thing to keep in mind about these controversial cases is that with abortion rights, with the new ruling this year that businesses can decline to serve gay customers if they don't agree with that, and with this student debt decision, the Supreme Court is out of step with public opinion. They are invalidating programs that a majority of Americans basically agree with. It's a little dicier on affirmative action, which is a little more controversial. But Biden had the case to make in 2022. Look, the Supreme Court is doing stuff that most Americans don't want them to do. And Democrats overperformed in the midterm elections. They lost fewer seats in the House than expected. And importantly, they kept control of the Senate when it looked like they would lose it. So I think it is reasonable to think that if Biden is the candidate in 2024 and he plays this correctly, yeah, this could be a tailwind for Democrats.
Certainly going to be interesting to watch. Rick Newman, as always, thanks so much.
Bye, guys. Happy weekend.
Well, coming up, the final closing bell of the week, the month, and the first half of the year. We're going to recap the top stories and take a look back at the top movers of the last 6 months. Stick around.
Markets ending the first half of the year on an optimistic note as we ring in the final closing bell. The Dow closing up 282 points, S&P up just over 1%. The Nasdaq, the winner today, up just about 1.5%. 10 of the 11 S&P sectors closing to the upside. Technology, the winner on the day. Let's also take a look at Apple closing the day to the upside. Now, the tech giant's market valuation hit $3 trillion today on Friday, making it the first publicly traded company to close at that level, $193.97. Now, the moment coming as shares of Apple broke past $190.74 at the start of the trading day. The iPhone maker originally eclipsed the $3 trillion mark in January of last year on an intraday basis. And Akiko, we take a look at some of the recent commentary that we got out today from Citi. They don't think it's stopping anytime soon.
Yeah, 33% upside from the current price is what Citi analyst is looking at. It's been interesting to see the run up for Apple when you think about the trajectory over the last 6 months. They're certainly not alone, just given where the big tech names have moved up. But looking specifically at this Citi note, I do think it's interesting that they're still looking at iPhones as a big driver here. The higher end specifically is what the Citi analyst cites. Also, further market share gains in China and India. India, one that we've heard over and over in terms of the big opportunity. But Citi coming out with a street high $240 a share price target. We'll certainly be monitoring that to see that it reaches that to that level. Shares of Chinese EV maker XPeng Motors closing the day higher. The car maker launched its new GS Coupe SUV in China, coming in at just under $29,000. That's below the price for Tesla's Model Y, which is currently $30,000 in China. There's a number of ways to look at this, Shauna. Obviously, we've been talking about the aggressive price cutting that's been happening in the Chinese market, still the largest EV market, but also XPeng's had its own challenges. When you think about the deliveries, a steep drop, 26% decline year on year in the month of May. So they are really trying to get the deliveries going, the sales going. This is an aggressive move. It's going to be interesting to see what the rest of the market does, how they follow. But, throwing down the gauntlet yet again against Tesla, I guess.
Yeah, it's all about price. Certainly the reaction here from the street, at least they're encouraged by the pricing strategy. Citi out with some commentary saying that the pricing strategy is a good and rational trial, though they are maintaining their sell rating. And the reason there is just because of the valuation, saying that they think that shares have hit the valuation ceiling, at least for now. And Akiko, you're exactly right. When it comes to the EV market, specifically in China, they're up against some pretty steep competition. So yes, getting that price point to the level it is will certainly help them, you would think, demand-wise. But there are other options not too far from that price tag. Also, let's take a look at Constellation Brands closing the day lower, off just about 0.3%. Shares of the beer maker slipping just a bit after reporting first quarter earnings. The company beating analyst expectations on both the top and bottom line, but margins contracted thanks to raw material costs and marketing spend. Now, the company's beer sales did rise 11%, driven by the strong growth from Modelo, which just took Bud Light's place as the best-selling beer in the U.S. Certainly, we have seen other companies like Constellation, when you take into account their Modelo portfolio, benefiting from the boycott of Bud Light, but also questions there, Akiko, about whether or not that's going to last. If we do see people return to Bud Light, what that means for some of these valuations where the stocks have run up with its competitors.
Yeah, it is about just how sustainable that's going to be. But look, the stock is down. You could argue that maybe it is about expectations, but I mean, beer sales up 11%. I mean, that's certainly some strength, at least in the quarter.
Certainly is. But again, off just about 0.3%. All right, let's talk about what happened over the last 6 months. The first half of 2023 has been a whirlwind. But with the help of mega cap tech companies, markets have enjoyed sizable gains. With more on how stocks fared and even some surprise winners thus far this year, we want to bring in Yahoo Finance's Jared Blickery. Jared, what do we got?
Well, I'm checking out the sector action here. This is year to date, by the way. Tech, not surprisingly, in the forefront. That's up 40%. Then we got communication services and consumer discretionary. Yes, those are the mega cap sectors. And if you take a look at the Nasdaq here, Apple up almost 50%, Tesla 112%, Nvidia up 190%. Yeah, there was a lot of talk about too much concentration in the mega caps, and that was the case up until about a month ago, and it's still ongoing. I'm going to show you some of the catch-ups in a minute here, but let me just show you. This is a chart I came across yesterday. Top two holdings of the S&P 500, guess what? 14.4%. Apple and Microsoft. This goes all the way back to 1980, so a record within this managed time frame. And just a little trip down memory lane. Remember when IBM and AT&T in the early 80s were the two largest companies? I don't. Microsoft and GE around the time of the tech bubble, Exxon, Walmart around the global financial crisis. So you see how things have changed here. But let's get back to the present and cycle through some of the heat maps here. I told you things had changed. Well, let me just show you with our leaders. This is year to date, and in the upper left, we got Bito. That's a Bitcoin ETF. That's up 63%, leading the way. After that, Nvidia led the stocks up, or the stocks up. That's up 45%. But over the last month, we've had a lot of other sectors participating. Number one is home builders. Might be surprising to some people. Meme stocks, travel. XRT is actually retail. IYT is industrials. We got Bito. We got IPOs, we got ARK, we got KWEB, that's Chinese ETF, defense stocks like Lockheed Martin, and also gambling. All of those are outperforming. And so we did have a lot of breadth come back into the market over the last month. And you can see that in not only the NASDAQ, but some of the other mixes here. So this is over the last month. We still have the mega caps up really nicely, Alphabet down. And you can see it was a really broad participation over this time frame. You want to know what's come back? Regional banks. This is over the last month. A lot of dark green on the screen here. Chinese stocks have faltered so many times over the last few years. Those came back in a way. We can go through and we can also see even home builders. Home builders, a little bit surprisingly, but nevertheless, we're seeing a lot of green there. So really kind of a story of comeback for the other non-mega caps this quarter.
Some rotation. We'll see whether or not that sticks. All right, Jared, thanks.
Well, it is now time to look ahead to the long holiday weekend, and many Americans are looking to dust off their grills as we look to Independence Day. The National Retail Federation reports 61% plan to celebrate with a cookout, barbecue, or picnic, and many plan to use a charcoal grill instead of a gas or electric one. Now, grilling with charcoal comes with its own environmental concerns given its carbon dioxide emissions, but one company says it's found a way to reduce that pollution by at least 30%. Joining us now from Namibia in South Africa is Ben Jablonski, CEO of The Good Charcoal. Ben, can we start by talking about why you're in Namibia?
Yes, hi, nice to meet you. Namibia has a huge environmental problem called bush encroachment. The acacia bush is growing out of control in Namibia. The size of the problem is 2.5 times the state of Georgia, and animals like the cheetah are really running out of room to hunt, and they're dying. And we're taking that acacia bush, making it into charcoal, and bringing it to the United States.
Ben, talk to us just a little bit more about that transportation process, just getting it here to the U.S. and the cost of that. When it comes to an item like this, I think a lot of people would think that, hey, maybe it costs a lot more than what they typically buy when they're trying to grill with charcoal for the summer. So how does that stack up?
Well, transportation was much higher during COVID, but it's come down quite a lot. And luckily, we can bring a lot of bags in a container and make the price really affordable for the American consumer.
What does the demand picture look like right now? I mean, we're showing here some partnerships that you already have in place. We've kind of grown accustomed to those grills that are just sort of an easy turn on, right? Whether it's gas or electric. What are you seeing on the charcoal side of things?
So people are wanting to cook more authentically and with better flavor. And the Good Charcoal really allows you to do that because we don't have the chemicals, so it's better for you. And like we're now in Sam's Club, Target, and we're actually launching in selected Kroger's this weekend.
Yeah, Ben, you certainly have a lot of strategic partnerships. So going back more so to that demand question, just even getting your message out there, just that this is an option, what does that look like?
Well, as a startup, it's pretty tough. And we just do a lot through social media. We have a lot of brand ambassadors, and we're really focused around grill enthusiasts and families because people want to take care of their families by having a healthier product that's sustainable and really burns hotter, so you need less.
So how big of a boost is this holiday weekend for you?
Well, we'll usually see 2 to 3 times the typical week on 4th of July weekend. People just love to grill and get together with their families, and we're all about it.
Ben, I believe you started this company just about 2 years ago, what was still the middle of the pandemic. What was that like? Just the biggest lesson that you learned at launching a business at what was a pretty tough time?
Yeah, so me and my partner, Rob, we took 4 planes from New York to Africa, and we really just fell in love with Namibia, which is a beautiful country. But I think COVID was a pause for many Americans to say, what's important to us? And for me, as an Aussie who grew up grilling, it's important to have a healthier option, a sustainable one that people can really enjoy and get behind.
All right, Ben Jablonski, CEO of Good Charcoal. Thanks so much for joining us here, and happy 4th.
Happy 4th. Have a good one.
Well, it's closing time here on Yahoo Finance. Here's a look at what to watch next week. It is a holiday shortened week on Wall Street for the July 4th holiday. Markets are open for a half day on Monday and closed on Tuesday, but it is still a busy week on the economic calendar, especially for jobs. The June ADP report is out on Wednesday. The expectation is for 240,000 jobs out of that report coming ahead of the monthly jobs report on Friday. The expectation coming there at 225,000, and certainly a number that a lot of investors will be watching.
We will also be keeping an eye on the travel chaos that's been plaguing airports across the country. Thousands of flights on Friday have been canceled and delayed, which is set to be the busiest travel day of the holiday weekend. While weather has been to blame for many of these cancellations this week, some airlines are also blaming the FAA and the shortfall of air traffic controllers.
And Tesla shares in focus as the company is due to report its second quarter deliveries. They are expected to hit a record of 445,000. It's going to be a sign of how Tesla's aggressive price cuts affected sales. The news will likely drive Tesla shares next week, which have already doubled so far this year.
That does it for us today on Yahoo Finance Live. We wish everyone a very happy 4th of July. We'll see you back here next Wednesday, 3 p.m. Eastern Time for all your coverage leading up to and after the closing bell. Have a great weekend.